Yeah, yeah. The balance of payment account. Balance of payment account. Now we said is the introduction. Closed economy without government. Closed economy with government. Closed economy means no import-export trade. Then you have the open economy. We have XM. GDP equals C plus, I plus, G plus, X minus M. So this is the actual size and the activities, transaction of an economy, open economy. You have the four sectors: households, government, firms, and the business and the foreign sector. Then you have markets, labor market, financial markets, and goods market. Within that market, you have a large number of players, different small markets. Then you have lots of transactions, transfers, taxes, savings, expenditure, imports, exports, like that. Because the rest of the world, if you think about the foreign sector, we import goods and services. We take loans. We export goods and services. We give some transfers. We use some loans, gifts to other countries, right? Foreign sector, import, exports, imports of goods and services, taking down loans, right? Then to explain this whole economy, we said there are several accounts, national accounts, public finance, we discuss budget, balance of payment, another account. Balance of payment is an account. Double entry bookkeeping system is used. So T account is there. Then the monetary survey. Now today we are going to discuss the BOP. What is BOP? The BOP is a record of transaction. Record. It's a record of transaction between residents of a country and another country. Where do we record these transactions? In an account. It's an account. You have to, when you say account, you have to credit, debit, inflow, outflow, credit and debit. And all inflows into the country from the foreign sector is entered from the foreign countries, entered as credits. All outflows are debits. Now this account is for the whole economy, whole Sri Lanka. Sri Lanka versus rest of the world, other countries. Exports, goods and services, imports, goods and services. We borrow loans, give loans. Foreigners buy treasury bills. Foreigners buy treasury bonds. Foreigners buy shares of the PKH, local companies, blue chip companies. Right? Foreign government give loans. IMF give loans. China, when China purchases the lease out the Hambantota for a longer period, then they give 2.7 billion to the country. Right? So these are foreign transactions. These transactions are entered in an account. When you say account, there's a balance. At the end of the year, you have a balance. Credit, debit. Sometimes it's the credit balance. Sometimes there will be a debit balance. If there is a debit balance, we call balance of payment deficit. If there is a credit balance in the overall account, we say that there is a balance of payment surplus. Balance of payment is an account. In that account, we record all the transactions between residents of a country and residents of other countries. Import, exports. When you say imports, companies, government, individuals, all included. The residents. So the whole economy. If you add that, who compiled this balance of payment? Central Bank of Sri Lanka, the compiler. Central Bank quarterly prepare this balance of payment, half yearly prepare, update, then the annually update. Central Bank have the access to the banking data. All the transaction, financial transaction come through the banks. Directly, sometimes some transactions come to the central bank accounts. But all these financial transactions, information about the transaction can be obtained from the banks, commercial banks, balance sheets, right? All the transactions, the bank balances. Otherwise, if these transactions are not going through the bank remittances, banking sector, the commercial banking sector, then suspicious transactions, STAs are there. Sometimes even bank also can raise STAs, right? Suspicious transaction, the actions, or sometimes it is illegal money. Illegal money won't come through the banks. Suitcase of the notes bring to the country, right? Nobody. These are black money. So the purpose of these black money dealers is to wipe this, laundering this black money laundering. Black money is there. You launder, clean that, iron that, laundering that, then you get white money.
Excuse me.
Yes.
So we have already did this.
Sorry?
We did this.
No, we are not. I'm not going to discuss this. This is only to introduce the balance of payment. Now I'm going to shift to the other one, right? Shift to the other one. Now just we are discussing balance of payment account, right? The balance of payment surplus, deficit. Then we move to the others. Of course, I have discussed national accounts. This we have finished that, no problem. So now we move to the other one. Now we have to know about what is balance of payment. It's an account. What kind of transactions are entered? Foreign transaction between residents and residents of the other countries. There can be balance of payment surplus or a deficit. But now we are going to discuss overall balance of payment account. In the Central Bank Annual Report, Chapter 5. Chapter 5 is about external sector performance. External sector performance, Part 1. Chapter 5, external sector developments and policies. External sector development and policies. I have copied this from 2019 annual report. I have copied how many tables? 5.4. Yes, 4 table. Based on this, we are going to develop this discussion. Right? We are going to discuss this BOP. Right? So we said BOP is an account, but in this account there are sub accounts. So this account, overall BOP is like a wardrobe. In your wardrobe, right? In your wardrobe, first drawer, first one, second, you keep your day-to-day the clothings and the saris and all the other things. Then like that, or you can say like the reading table. You have your computer, you have the reading materials, novels, videos, sometimes the musical records. You keep it's in order. So like BOP is an account. In that account, you have the sub account. The sub account, specific transactions are entered. So the overall BOP we divided into current account and the capital account. Current account, capital account, and financial account. Current account, capital account, and financial account. That is one classification, overall BOP. Then within the current account, we have another sub account. Trade account, service account, primary income account, secondary income account. Then you have the capital account. So each of the sub account can have debit balance or the credit balance. Debit balance or the credit balance. Central Bank Annual Report, they compile the BOP both in terms of US dollars and the rupees, local rupees, right? So when they compile this, balance of payment overall, this transaction, entering of transaction, there are certain standards. Internationally recognized standards are there. For the BOP version, the standards version 6, now they are using. In that version, it's a booklet. They are given all these accounts, how to classify a given transaction, whether you go to the trade account or the primary account or the financial account. They give this classification. Why this international classification is important? For international comparison. Countries can compare India and Sri Lanka's BOP. They are comparable. When you say current account deficit or the surplus in a particular account, they are comparable. You know the meaning. These are the activities coming under this each account. So then you can understand international classification. So BOP, the balance of payment manual, BOPM manual version 6. Yes, BOP manual version 6. I can check that. Yeah, usually they give the reference BOP at the end of the year. Now these are the sources. What are so how to get this information? Ceylon Petroleum Corporation, Gem and Jewelry, Sri Lanka Customs, Central Bank of Sri Lanka, like that. Yes, the BOP, yeah. But anyway, since I think BOP manual version 6 is used to classify, compile this account. Okay, now let's go back to the table 5.1. Now this is the summary analytical presentation in chapter 5, first data table. Now we can understand each sub account. Overall BOP, we said current account. Current account, again we divide into trade account. In this trade account, we entered all the visible transactions. Visible, tangible, goods, merchandise account, which is also called merchandise account. Exports of goods, imports of goods. Exports of goods, imports of goods. Then the services are entered in other accounts. Services, the net primary income, the payments, receipts and payments. Secondary income, receipts and payment. The secondary income, receipts and payments. Then the capital account, very small account. Small account, after that current and capital account balances. Right. In this current account, the largest account is the trade account. Trade balance, trade account. Trade account, you have the two sides. Exports, imports. Exports of goods. We export tea, rubber, coconut, minor spade crops, tangible goods. 2019 value of this exports, total exports was in terms of US dollars, 11.9 million. 940, that is 12 million worth of exports. Our total earnings by selling our goods to foreign countries, we have earned 12 billion. You can say 12 billion, 12.9 billion, the 12 billion, the dollars. See what is imports. Imports is nearly double. 2018 is double. 2018 exports 11 billion, 11.8 billion, imports 22 billion. Double the import expenditure. Expenditure, debit. Import expenditure on debit. On imports, we import cars, we import crude oil, we import the fertilizer, we import the investment goods. Then money going out, dollars going out, foreign exchange going out of the country. That value is about 19. It's a 20 billion in 2019. See the exports. Our earnings is about 12 billion. Nearly double. Imports expenditure is nearly double the exports earnings. There is a deficit. How do deficit? Credit minus debits. Inflow minus outflow. Inflow minus outflow. 11.9 the billion minus 19.9 billion, 7.9 billion deficit. Current the trade account, there's a deficit. There's a deficit. Right? Trade account deficit. Service account, you have the surplus. Services net. Then the primary income account, you have again deficit. Second income account, again surplus. So overall current account deficit. Overall current account deficit. What is the overall current account is? Balance in the second income account, balance in the primary income account, balance in the service account, balance in the trade account. In other words, minus 7.9, 2.8 plus minus 2.4 plus 5.7. When you add all these things, you get current account minus 1.8, that is deficit. Current account deficit. What does that mean? All the current transaction, if you consider all the current transaction, outflow higher than the inflow. By how much? 1.8 billion. More outflow than the inflow. Outflow trade balance is 7.9, that is outflow. Service account net, there is a surplus 2.8. Then the primary income account, there is a deficit. Deficit will come one by one again. There's a deficit. Second income account, surplus. So we have only two surplus accounts, service account and the second income account. That is interesting. Overall current account still can have a deficit, can have a surplus, still the second income account surplus. Second income account surplus 5.7. That doesn't imply the current account surplus. Why is that? That surplus is compensated by other deficits. That is happening here. And this is one of the past paper question, true or false question. The trade account or the current account can be a deficit while the second income account has a surplus. True or false? Explain. True, because current account consists of four accounts. The second income, primary income, services and trade. So overall balance in the current account depends on balances in these sub accounts. Now take the second income account. Key items. Most important item is worker remittances. Worker remittances. Sri Lankans, those who work in Middle East countries, those who work and earn in Australia, USA, Germany, European countries, then they send part of their savings or transfer part of their savings to Sri Lanka. Worker remittances, but majority of earnings coming from Middle East. Other countries, of course, Australia, USA, maybe China, European countries, working Sri Lankans working in those countries, they send their earnings, part of their saving, maybe a small amount they send. But the Middle East countries, our Sri Lankan workers, housemaids, they are quantity surveys, engineers, they are servings, out of their total earnings, the significant proportion comes to Sri Lanka. Because of course they need their living, the expenses they have to bear, but otherwise to look after their parents, their families here, they send money. How do they send money? Through banks. Actually legal channels. Formal channel is the bank, is it? Right? So you go to the bank, from the bank, they remit this money to Dubai Bank, send that money to the Bank of Ceylon or the People's Bank or Bank of Ceylon, they credit that to that money, converting rupees into rupees to the particular the worker, the domestic workers, his relevant relatives account, rupees comes through banks. But there are other means, other agents are there now. They are doing these things, right? The remittances are there. Lots of these remittance service providers are there. Service providers are there, right? Every bank has service providers, right? The service provider, not only the bank, they are mainly to remit this money into the country. So remittance providers, banks, through the banks, remittance. That is also official, right? The remittance providers are there. Then then you have other channels. Sometimes people send their money through their friends. They give dollars or the euro to some of their friends, come into Sri Lanka. They come to Sri Lanka and they distribute that money to the person, family living in Maravilla or the Nigambu. These people hand carry this money and give that money to this one. Fourth method is the Hawala system, Undial system. In this money, in this channel, what will happen? Those who are working in those countries, they give their earnings to the particular agents, particular person, informal sector agent, sometimes Sri Lanka or the Sri Lankan company, to that person. Euro. They give euro $100 to this company or this person. Agent of this company is living here, Maravilla, Nigambu, or this area in Colombo. Then immediately they by transaction they send the value of this $100 100 euros here in Italy. Equivalent amount of rupees are given to this family by the agent in Colombo, in Nigambu, right? That is not a formal or legal, that is illegal transaction, right? Undial is illegal, but the thing is, it is happening. It is happening in not only Sri Lanka, almost everywhere. Indian workers send their money through Undial system. Illegal. Why is that? Very quick. When you give money, this $100, 100 euros to that person, within 10 minutes time, this or the 15 minutes time, your beneficiary in Sri Lanka get the money. Trust. It is a trust-based thing. Mainly trust. That person can cheat you. You are giving 100 euros, but the person will give equivalent amount of 50 euros, rupees. This kind of the collapse of trust, but it is based on trust. But a banking transaction, it is not that. Other the service providers transaction, not that. It is trust, not the trust. They are highly legal. So, but Undial system cannot be avoided. Okay, service worker remittances is the main item, the credit item in the second income account. Right? Second is then the service account. Service account net. You have the tourist arrivals. I go to this one. Yes. Excuse me. Hello. Oh, yeah. Oh, yeah. I'm going to get in the lecture. I just say, hey. Hey. Oh, right. Oh. Right. Sorry. Right. Okay. Then I will read this. The primary income account. The mainly tourist earnings and transport earnings from air passenger services following the Easter Sunday attack. the deficit in the primary income account, mainly tourist earnings. Tourist earnings is there in the primary income account, service account, primary income account. So the tourist earnings, service account, service account, primary income accounts. Service account. Sorry, I'm sorry. The second account, tourism, earnings from tourism entered in the receipts as the service account. For example, you can say total earnings in the credit item receipts was 8.3 billion, but the 2019 it was 7.4 billion. 7.4 billion, right? It has decreased. 2019. The reason is tourist arrivals went down because of this East attack, right? After that, all the tourism sector collapsed. Your earnings decrease, right? Payments, tourist payments, debit item is our Sri Lankans go abroad, go to Buddha go to the other countries, the Mecca or the Italy, that is to visit popes. Then there are tourism or some recreational thing. Lots of these tour agents arrange to group travels to China, Malaysia, Vietnam, USA, cruise travels. All these expenses related to ticket and other expenses are entered in the service account. Payments, debits. Those who coming to Sri Lanka, when they spend in this here, they come and their air ticket, they spend here in the hotel charges, hotel rooms, then they travel to Sri Lanka, lots of expenses. These receipts, tourist receipts are entered in the service account. Remember, trade account only goods. Service account, services. Then primary income account, mainly in primary income account, I will read this. Primary account, the deficit in the primary income account widened marginally during the year, increased reinvested earnings and dividend payments by direct investment enterprises. So direct investment enterprises, because the foreign direct investment, their earnings, when they send this money out of this country, or our investment in other countries, when they remit their earnings here, are entered in the primary income account. So the credit item 249 million, 250 has increased slightly to 252 million. But the payments 263, 2,633, 2,678, right? Service account, primary income account, then the secondary income account. Main item we discuss work remittances. Work remittances is a huge. This is 2019 situation. Now, what do you think? 2020, 2019. Then we started this. The COVID issue comes 2019 December. Then March lockdown. So after that, our tourism sector, Middle East, the workers start coming to this country. All the quantity surveys, all the engineers, most of the majority of them. Still, they say 50,000 people are waiting to come to this. They are unemployed. Huge unemployment. Tourist earnings definitely. The next annual report you can see in the April it is coming. This work remittances, huge drop in work remittances, around 4 billion to 3 billion to 4 billion. 7 billion, 7.0 billion work remittances in 2018, 6.7 billion 2019. This year it will be around 4 to 5 billion. Right? Huge drop. Now what happened? When these the inflows drops, even exports also drop. Export earnings also will go down. Will go down 2020. Then what will happen? Your deficit, current account deficit increases. 18 to 19, there's a slight drop, minus 27 to minus 18. Deficit decrease. But 2020 deficit might increase. We don't know by how much. There are some government has imposed some restriction on imports, cut down imports expenditure, but definitely deficit might increase 2020. Right? Right. So inflow, outflow, inflow and outflow, inflow, export earnings inflow, import expenditure outflow, tourist receipts inflow, tourist payments outflow, primary income receipts inflow, payments outflow, work remittances inflow, payments outflow. Right. Then the capital account is a very small amount. I'll come to that point again. Then the major account is the financial account. Current account, capital account, then financial account. Financial account. Current and financial account balance is again 1.78. What is the current and capital account balance? Balance in trade account, balance in service account, balance in primary income account, second income account, and capital account. That is deficit 1.78 deficit. Current account only 1.8 deficit. Outflow greater than the inflow. Right. Okay. Now the foreign financial account. What are the key? Now I am not going to discuss. The thing is, we are not going to discuss all the transaction. We will not be able to finish the discussion, but we have to know. You have to know what are the key transactions in this financial account. Financial account, we all the sale of assets, sale of foreign direct investment, transaction related to foreign direct investment, transaction related to sale of assets. If you sell particular Sri Lankan owned the government owned the asset to another country, you get receipts, sale of assets. If the Sri Lankan government purchase the building in US for their embassy, outflow of dollars, this is entered in the or some investment entered in the sale of assets or purchase of assets is entered in the financial account. Then purchase and sales of financial assets, treasury bills, treasury bonds. Then you have the time to time central bank on behalf of the government issue international sovereign bond. Sovereign bond. What is sovereign bond? Dollar denominated bonds to other countries to raise funds, dollar funds to Sri Lanka, roughly about, right? Then it was about 2019, we have issued the international sovereign bonds amount to US dollars 4.4 billion. 4.4 billion to other countries, sovereign bonds. Then we had other foreign countries, foreign investors to invest in these sovereign bonds. Sovereign bonds means government guaranteed, 100% guaranteed bonds. Zero risk bonds. They can buy. So the foreigners, when foreigners buy those things, the dollar inflow, these inflow, financial assets, selling of financial assets, buying of financial assets, they are entered in this financial account. Direct investments, assets, direct investment liabilities. Portfolio investment is, direct investment means foreigner come and buy the land, bring the machinery, hire the workers, set up the factory and start working. Direct investment. But portfolio investment is foreign investor buy our treasury bills, treasury bonds, investment in treasury bills, treasury bonds or shares. They are classified as portfolio investment. Portfolio, miscellaneous. Compared to the direct investment, portfolio investment is more volatile, If something happens, some uncertainty is coming with the economy, developing in the economy, foreigner just sell and bring their money abroad, take out. Portfolio investment. Direct investment is more stable. Direct investment, so that's why the countries always want to promote FDI, foreign direct investment. Foreign direct investment. We invite the foreigners to come and invest here, direct investment. We give so many tax the benefits, tax holidays to them, invest, encouragement. You say 5-year tax holiday, you are not supposed to pay taxes. Please come and start your factory, your own factory here. And for example, this Samsung, the headquarters, the main factory is in Vietnam. It's a huge foreign investment for FDIs to Vietnam. Vietnam, I have seen that factory, Samsung, the main factory headquarters, Vietnam is about huge factory. Foreign owned company, they invest in Vietnam. If you can get 1 or 2 companies, the foreign direct investment from one of these 2 companies, big companies, international companies, you are much better off. You'll be better off, right? That is, government is struggling. Government is giving incentives. Government is inviting the foreign companies to come and invest. China is come and invest. China is one of the main the investors, FDI investors in Sri Lanka. Right? So the India also another the investor. Right? So the FDI is more important than the portfolio investment. Remember again, in the balance of payment account, you have the direct investment, assets and liabilities. Assets and liabilities. In the current account, we say receipts and payments. Here it is assets and liabilities. Portfolio investment, equity and debt securities. Equity and debt securities. Mainly the equity and debt security. Equity, buying shares. Right? Is the debt securities. Company, MAS, branding issue, international bond, raise funds, then it's a debt security, right? Treasury bills and bonds, debt security. Buying shares, equity investment. These are entered in the portfolio investment. Then the other one is the other investment, mainly the other investment liabilities, currency and deposit. I just want to get loans. Another important item is the loans by the central bank, deposit taking corporation, that is commercial bank. Commercial banks can go up to certain percentage of loans. They can borrow of their total assets up to a certain percentage. They can borrow from foreign countries. That is the deposit taking corporation, general government loans, and then the other sectors. Loans are entered. Buying and selling of assets, portfolio investment, direct investments. These transactions are entered in this financial account. Trade and credit advances. Then you have the financial account. Again, you have the IMF loans. IMF loans is there. Yes. The financial account was augmented significantly. Financial account proceeds from the issuance of international sovereign bonds. Financial account. Amounting to $4.4 as well as the receipts from 2 tranches of the International Monetary Fund extended. IMF also, countries with they give short-term loans with some balance of payment difficulties. IMF they come and evaluate our situation, country situation. Then they give some relief, rescue the packages to Sri Lanka. Right? Then they divide that to tranches. They don't give, they give 2 billion. 2 billion is not released at once. IMF say, okay, first quarter, second quarter, third quarter, first tranche, second tranche, third tranche, like that. Any movement, IMF can say, okay, they can give only 2 tranches, and if some of these, along with that, IMF propose some changes, structural changes in the fiscal and monetary policies of the country. If we do not comply with the proposed the mechanism, they might stop third tranche, fourth tranche, tranches, right? So you approve certain amount by tranches, they issue this. So in this case, I want you to take down the reference, chapter 5, first 2 pages, overview. One of the largest, the chapter. So please read Central Bank Annual Report 2019. This year you are getting question from 2019 Annual Report, not 20. 20 report will be coming on April 19th. Then that is the loans, buying and selling of assets, FDIs, or in other words, a portfolio investment, loans, foreign loans, foreign. So foreign, not the rupee, not the domestic sector. Now this account is prepared for the rest of the world. Transaction between resident rest of the world and the resident in other countries and residents in this country. When you say residents, you don't say the layman's language, residents mean the people. No, resident companies, residents government. Residents mean the broader definition is the residents. Residents in this country and residents in other country, we prepare this transaction, right? Okay. Then what will happen? Overall, now we have current account, capital account, financial account. Then when there are some small amount errors and omissions. Errors and omissions, some reserve assets are there. They are also entered. They are not that important. Transactions, monetary gold, special drawing right, reserve position of the IMF, the other reserve assets, they are also coming under capital account, the financial account. Overall balance. What is overall balance? Current account balance plus capital account balance plus financial account balance. Coming the overall balance. For example, 2018 overall balance was deficit 1 minus 103, 1.1 billion deficit. 2019 surplus, overall balance 377 surplus, million US dollar surplus, million US dollar surplus. Now we'll see this, what will happen. Why is that? This surplus, you know, current account, there is a deficit, minus 1.8. I am referring to 2019 numbers, minus 1.8 deficit. Then what will happen? Financial account deficit 2.432. Then you have the deficit coming from surplus or reserve asset 377. You have to add these reserve assets coming. You add these reserve assets. Financial account. Then what the 377 is how much? Wait a minute. Current account minus 180. Then the current and capital account minus 1.785. Financial account net 2438. Financial account net. Then reserve assets 337. Yeah, I have not calculated exactly to the derivation of the overall balance. C is what? Let's see the C. C is refer table 512 for the derivation. Oh yeah, I'm sorry. The overall balance is not simply you add this account, balances in this account as a, you add, overall add, and some other items are there to calculate the overall balance. That's why they have given some reference here, part C in the central bank annual report. You have to go to the the table 512 for the derivation of overall balance. Overall balance. So remember, overall balance is not the balances in all these three accounts plus some other items. They have given this in 5.12. 5.12 is their small table, is their calculation of overall balance. Overall balance. Page 198. They calculate the overall balance. Page 512. Reserves, overall balance. Overall balance is calculated in the table item 8. They calculate the overall balance. Indirectly, they calculate 337. Please refer the 512 also. This is how they calculate the total overall balance is there. Right? Please take that also. It is a great impact is there from these three accounts. Right? I'll summarize this again what we have discussed. Balance of payment is an account for the whole country. There are two sides of this account, like any other account, credit and debit. All credits are the inflows of dollars, foreign exchange into the country. Debit items are inflow of dollars out of the country. To the classification purposes, the overall account has been divided into key main accounts: current account, capital account, financial account, and other. Right? Current account, again, three sub accounts. Then you have the financial account, capital account, and the financial account. Yeah. So the current account, all current transactions are entered. not the sale of assets or the investment activities. Getting loans are not entered. The current account, current transaction, buying and selling of goods, buying and selling of services, current transaction. Not the investment, the bigger lifespan activities are not entered. They are coming under the financial account. Loans, bigger lifespan, the repayment period is bigger. Loans entered in the financial account. Real assets, purchase and sale of real assets, and the purchase and sale of financial accounts are also entered in the financial account. Right. Overall balance. Now we will see what will happen, why it is important. So when there's an outflow, when there's a more outflow is higher than the inflow, what will happen? Oh, sorry. For all the sources, countries, dollar outflow from the Sri Lanka is higher than the inflow of dollars. Deficit. What does that mean? What does that mean? If there is a surplus, there can be surplus. Inflow from all the sources can be greater than the outflow of all the sources. So, accumulated dollars foreign exchange in this country, in the country, these accumulated will add to the reserve position. When there is a surplus in the balance of payment, our reserves will improve. Our reserves will improve. For example, January country's foreign reserves in dollars, let's say 100 million. Within the country, all these transactions will generate, suppose, generate another $25 million surplus. Then what will happen? End of December, total reserves will be 100 million opening balance plus 25 million flow. Balance of payment surplus, 125 million. End of the year, you have the reserve position of 125 million. Good position. Suppose there is a overall balance negative, deficit 25 million. Starting reserves, foreign assets total 100 million. Deficit is minus 25, 100 minus 25 is 75 million. That's a drop in reserves. Drop in reserves. Reserves discussed. So therefore, this balance of payment status implies directly what is happening to our final balance, happening to our reserves. Reserves, foreign reserves are important. It is your credit worthiness. Right? Depending on that, when you borrow, when you get loans, your interest rate also matters. Depends on that, your credit worthiness. For example, if you take a household, your household, you have at the moment your assets, your car, your house, your jewelries, assets. Sometimes financial assets, treasury bill, treasury bond, shares, at all these assets. This point. During the year, your flow, income flow, inflow, outflow, but within the year, if you have surplus of income and you convert this income to buying assets, then that asset add to the opening assets to calculate the household assets. During the year, you have a budget surplus, household budget surplus. You use the surplus to buy some some construction activity. Get some extension to your house. Then end of the year you have the old house. This end of the year you have old house plus the extension. Assets level increased. If you invest all your net earnings to get this extension to the household, or you can say you can use this surplus during the year to have some electricity connections, consumption purposes, something other thing. If assets, you can add financial assets also. Using surplus, you go and buy treasury bonds, treasury bills, assets. Assets might increase. So assets implies foreign assets or the domestic assets, your household assets implies your credit worthiness. Credit worthiness, right? Income and the assets. Asset is more important. countries' foreign assets, very important. Foreign assets is more important. Foreign asset is measured using number of months you can import using that assets. If your foreign assets is, let's say, the $1,000, $1,000 million, your monthly earnings is monthly expenditure on imports 100, total assets 1,000, monthly import expenditure 100. How many months of imports can be financed using these overall assets? 1,000 divided by 100, 10. So the assets are stated using the equivalent amount of months. 5 months of imports can be financed. 10 months of imports can be financed using assets. Right? So there's another way to express these assets. Assets sometimes say $1,000 million. That's all. Or you can say equivalently 10 months of imports. So this is also going up and down. Reserves in money terms going up and down. Equivalent amount of months, imports, equivalent amount of imports also going up and down. So the assets, import. Balance of payment has a direct link between, a strong link between balance of payment, the position and the assets, foreign assets, right? Okay. Now, these are the balances in the as a percentage of GDP. Now you can see trade balance dropped. Good deficit dropped as a percentage of GDP 11.7 to 9.5. Good sign. Why is that? Because the import restrictions, they restricted imports, dropping imports. So the exports dropped 2019. At the same time, imports also dropped. That's why net position, the trade account improvement. 11.7 deficit to 9.5 deficit. That is also deficit. But we call trade account has improved. Deficit decrease. Goods and service account 7 to 6.1. Improvement. Deficit, but improvement. Current account 3.2 to 2.2. Improvement. Current and capital account 3.1 to 2.1. Improvement. Right? Okay. These are the, so in that case, 2019, all our accounts have been improved. The improved all deficit. Deficit means outflow greater than the inflow. But compared to 18, position is okay. Now 2020 numbers, please go through, compare these tables. The 2020 annual report will be out on April 30th. Yes, April 31st. Yes, then you can compare. Go to this relevant table and compare what is happening to our trade balance, goods and service account, current account balance, imports, exports, FDIs, right there. Okay. Now we go to the export sector. That is also knowledge about the export. Exports coming under trade account exports 11.94 not the US dollar million 2019. Second table you have this breakdown 11.94 not trade exports 11.94 not trade exports last row before the last row, right? One before the last row, right? Okay. Now we'll see exports. What is our export position? Exports. We divide all exports into 3 key sectors, 4 key items, categories: agricultural exports, industrial exports, mineral exports, unclassified exports. Small items, unclassified. Agriculture, industry, mineral, unclassified. Agriculture, what are the main exports? Tea, rubber, coconut, spices, vegetables, unmanufactured tobacco, minor agricultural product, seafood also there. Now these are the agricultural exports. Total value in 2019 was $2.461 million, 2.61 the 0.9, 2.62 US dollars million. Industrial exports. Industrial exports. What are the items? Industrial exports. Industrial exports is the biggest item. Biggest item, right? Then what will happen? Textile in this industrial export, still textile dominates. Of the overall exports, industrial exports dominate. Of the industrial exports, textile is the highest, giant. Textile and garments, right? The rubber products, petroleum products, gems and diamonds, jewelry exports, 305 million. Then the food, beverage and tobacco, $447 million. Machinery and machinery plants, 400 million. Printing industry, 48. Transport equipment, leather and travel goods and footwear, ceramic products. Other industrial exports, 962 million. So still industrial export, of the industrial export, remember, textile and garments dominate. This is the problem in our the overall export sector. Now, we introduced this garment sector in 1978 when we opening up this economy, our economy, 1978. Then 1990, 80s, 81, 82 period, this garment industry, was booming, start booming, right? So we get quotas, we export. Our major exporter is to the garment, US is the major, the key buyer, right? So the textile and garments. Then again, the European countries, West Germany, and the European countries, another buyer, right? You can see the exports composition is there, export composition is there. In the annual report, you can see what are our exports performance. Country-wise chart is there. Country-wise chart is there. Please go through that. I can't give you all the information. Export destination. Destination, export destination. Table, page 181. Figure exports by destination is there. Figure 5.7. 5.7. I can, the USA, 25% of our exports going to USA. Export, total export, mainly garments. Then another 17% go to EU countries, European Union. 5% to Germany, 6% India, 10% the UK, Middle East 11%, Asia other 10%. Our main trade partner, buyer is USA. Remember, 25%. 25%, it is falling, but still of the total exports by destination goes to USA, right? Value-wise, also 2019, 2019 it has increased. Now I was reading 2014 number, 2019, 26%, USA slight improvement, USA. EU countries, slight drop, 17 to 16%. Germany 5%, India 6%, same. UK, that's a drop, 10 to the 8%, like that. By destination also exports you can calculate. What is important in this table, this total exports, 4 sectors, 4 categories. Each category you have the agricultural, again tea dominates agricultural export, tea sector dominates, value-added tea and the raw tea, value-added tea, packeted tea, value-added tea we import, Delma tea, you can see in Australia, in most of the Asian countries, sometimes USA, most of our exporters trade dominance, Delma tea is there. So the exports, value-added tea, packeted tea, then the raw tea also we send that, right? Then the coconut, first tea, then you have the coconut or the spices, spices mainly go to the Middle East, like that. This is the classification. Seafood also emerging sector, right? Okay. Agricultural exports, textile, garments, rubber, and so these are the export earning. Inflow of dollars, supply of dollars. Who buy? Foreigners buy, demand our products. They represent the exporters. Exporters represent the supply side of the foreign exchange market. Exporters supply dollars. Exports represent the supply of dollars. Supply of dollars. When more and more exports come, supply increases. Supply increases. That has an impact on exchange rate also. Exports. Right. Change. What has happened in all these sectors? Agriculture export dropped. US dollar terms, 117.4% drop. Change in value, value-wise, year-on change 4.6%. Then you have the industrial exports, value-wise, there's an increase, 9258 to 9426. That's an increase by 162. Right? Mineral exports, 34.4 to 33.9, small drop. Value-wise, 0.5 drop. Right? Right. Okay. Okay. Now we'll go to this is the credit side of the trade account, exports, 11940, trade account, exports value, imports. Composition of imports, similar table to 5.4. Again, imports, very important. Imports represent the outflow of dollars. Outflow of foreign exchange. When you buy a car, worth maybe $25,000 car, then $25,000 going out of the country. Outflow of dollars. When you buy oil, when you buy the fertilizer, investment goods, dollars going out of the country, import. Again, like in the export, we divide overall imports, expenditure into three key sectors: consumer goods, intermediate goods, investment goods. Consumer goods, intermediate goods, investment goods. Who dominates? Intermediate goods dominate. Intermediate inputs, oil, fuel, this one. Textile and textile articles. So let's discuss about the intermediate goods. Overall imports, you can see, I give you the total 19 overall imports for stable, 19.937, 2019 imports on the trade account. Table 3, you have this 19.937. 19.937. That's a breakdown. This is a breakdown. Consumer goods, intermediate goods, investment goods. 3956 plus 11369 plus 4602 equals 19.19937. Right? Then what will happen? The consumer goods, intermediate goods is a giant, $11,369 million. Within that, 3.8 billion or 3891 million dollars, US dollar million, we spent on fuel, crude oil. Then textile and textile articles. What is that? We import all these threads, textiles, materials. Because the garment is the main exporter. Main finished product we send. But inputs are there. That's the thing. Exports, for example, garment exports earnings how much? Export earnings 596. Total earnings, export earnings. By selling our finished product to foreign countries, we get 5,000, nearly 5,596. But of that, roughly about inputs how much? Inputs how much? 2,900, nearly 3 billion inputs, 5.5 billion earnings, 5.6 billion earnings. 5.6 minus 5.6 billion earnings, 5.6, 3 billion the inputs. So value addition is nearly about, roughly about 5 minus 5.5 minus 3, 5.5 minus 3, 2.5. Real value addition. Because when you import the imports, money going out. Finished product, you sell. And 5.6 billion. But the imports, import cost is around the 2.9 billion. So you can see the value addition. Final value minus the material input. Roughly, you can addition. So government sector maybe, if you take output, huge. But one can say, look at your imports. Out of that 5 billion, so much of the around 3 billion imported input. So money going out to the country. Money coming in. 5 billion coming, 5.5 billion coming, 3 billion going out. So value addition. But still, the even export earnings on the intermediate goods, this considerable amount of money going out in the intermediate goods, they are out of the country as inputs. Then other diamonds and precious stones, chemical products, wheat and maize, fertilizer imports, fertilizer import 221 million, other intermediate goods 296. Intermediate goods means as an input, it's a value addition. You use these inputs to increase the value addition of the other products. Fuel is a key input, intermediate input, key input, key material input to the production of almost all the products. Fuel imports is around 3.8 billion US dollars, 3.8 billion US dollars, right? And second is the investment goods, intermediate giant investment goods, 4.6 billion, excuse me. Right. Investment goods, what are the key items? 4.6 billion value. Key items, building materials, machinery and equipment. Machinery equipment, 2.4 billion. Machinery equipment. Machinery equipment, 2.4 billion money going out of the country. Then what happens? Of course, the imports. There's a huge drop in imports of vehicles. Personal vehicles, 1573 2000 in the coming under consumer goods. It is not an investment goods. Investment good. That is interesting. If you buy a vehicle for your own use, that is classified as a consumer item. If you buy a vehicle for investment purposes, for your company, right, for your investment activities, then only it becomes investment goods, coming under investment goods. Classification. Personal vehicles classified under consumer goods. Personal vehicles, total 2018 1573, huge drop, 2157, 8157. Restrictions, some regulations were there, imports restrictions were there. Right, the banning of import. Why is that? Why does that? Now there's interesting the observation. Government has a problem because of this COVID. Then to tackle this foreign deterioration, outflow of foreign exchange, the draining of foreign exchange out of the country, government took some with the help of the central bank and the treasury, issue some circulars stopping non-essential imports, sometimes vehicles also. Non-essential, they are classified. Then non-essential, some they say some plastic products are coming from China. Now, like that, the huge HS code is there, they define. These are the non-essential items. These items are banned. You are not supposed to invest, import these countries. And they issue the circular to the customs. Customs officers check the LCs, and if, even banks can't open LCs to buy this item classified under this circular. Vehicles importation. Right. Even yesterday I checked the Samsung mine is S9 telephone. I want to this cover has been broken, so I want to usually buy this from the Tilakavadana. He said they said it is not coming, importing now. It is broken now. It's very bad now. Mine is this now. Always I'm using this phone. So then telephone this this flop this what do you call it? Is called what? It is called what? The telephone cover, not the cover. There's a small name. They are not importing that one. That is also expensive. This is coming under non-essential circular, import circular, right? So therefore, drop in importation. Governments wants to handle this outflow of dollars. Foreign reserve. Our reserves are draining. Why is that? On the one hand, our exports earnings falling, foreign remittances falling, worker remittances falling, inflow falling. Right? Then on the other side, then government impose some restrictions on the non-essential imports, small amount. So government intention is very clear. Central bank intention is very clear. Treasury intention is very clear. Clear. Right? Okay. Now in the import sector, you have to know what are the key sectors: consumer, intermediate, and investment. Under each sector, you have to know who are the giants. Then you can explain to if you want to control the outflow, what should be done, what sectors, what import should be controlled, right? Because in the consumer goods, except these vehicles, others, personal vehicles, others, you can't do that. Medical and pharmaceutical products, can you control? No. Home appliances, sometimes some items you can. They have done. Clothing and accessories, some items you can. But the medical pharmaceuticals, you can't do that. Right? Sugar and confectionery, you can't do that. Rice, you can't do that. Majority of consumer goods cannot be controlled. Import expenditure cannot be controlled. Intermediate goods also, fuel imports cannot be controlled. Textile and textile article cannot be controlled. If you put some restriction, garment sector will be affected. Then the imports, chemical products, wheat flour also another important item. That is wheat and maize. Fertilizer, small drop. Wheat and maize, small drop. The other intermediate goods, small drop. Now the thing is, how do you get this? How does the central bank get this information? What is the source? Source is given even for exports and import. Sri Lanka Petroleum Corporation send their fuel imports figures. Lanka IOC send their also fuel imports figures. Sri Lanka custom returns, right? Yeah. Central Bank of Sri Lanka, they have some banking sector information. These are the sources for these values. Sources over the values, right? Exports, you can see same. Petroleum Corporation and other exporters of petroleum, National Gem and Jewelry, exports, Sri Lanka Customs, Central Bank of Sri Lanka, sources, right? Otherwise, you might think, how do you get this information? No. In Sri Lanka, banking sector is the key. All the transactions should come through the banks. Financial transactions, LCs are open the banks, right? So therefore, you know the sources, data sources, you know the values, you know the distribution. Right? Then next table. These are the two tables. Yes, 4, 3, and 1. Okay. Now we have a general idea about the balance of payment. BOP account. All the inflow and outflow of foreign exchange dollars are entered. We do transaction in other countries also, but generally this account is compiled US dollar million. That is the most of the countries, almost all the countries in the BOP manual. That is the recommendation, right? If you want, you can our domestic currency you can calculate Even Japanese balance of payment, US dollars and Japanese yen. You can compile these dollars. India, in terms of US dollars and Indian rupees, they compile. Only US, you have US dollar million, US, right? Then Malaysia, US dollars in terms of US dollars and ringgit, right? Then Eurozone, Germany, France, Italy, the US dollar terms and the Euro terms. Compile the balance of payment. When you classify it, that's a very big standard BOP manual is there. Those instructions, standards, classification, procedures given in manuals are used to classify. For example, a new export, new exported items, new product is coming, our new market is coming to be found, right? So we have to enter these earnings, the service sector. We have to enter into the service sector. New product is we are importing. We have to import, enter this one. Now we import the 1,000 robots. Robots, now robotic engineering is very interesting. Now robotic engineering field is improving, emerging sector in Japan, in most of the developed countries. In some hotels in Japan, a receptionist is a robot. Right? Recently, I saw the CNN. This the room boys or the key holders are robots. Receptionist robots. Your key is handed over to a robot. Robot bring you to the relevant floor and the relevant the room. He direct you. Right? A pretty girl is there at the reception counter. You can talk to her. You can ask questions. She can answer in English or whatever the language. Some specific languages have been fed, so you can speak. Well dressed, right? If you are tempted and you touch her, you are slapped. Gently, you are slapped, right? Okay. So the robotic engineering is there. Engineering is a hotel sector. They are using airline industry. Sometimes operations, medical operations, very sensitive operations. They are trying. They are using the robotic engineering. The next generation, this robotic engineering will dominate sometimes the world. Most of the sectors, right? Robots, right? It's a developing, right? For example, people send shuttles to the moon and the Mars. They collect the soil, do all these interactions. Robots are going here and there, do the experiments. Right? Not the man, not the human, driven activities, right? So if you buy robots in the future, you can say it is classified under import, but it's a new item. Sometimes you may want to find under which account we should enter this. Then you refer the manual, BOP manual, and they say, okay. Like that, if new products, new innovation, new exported item, new imported item, new transactions are coming, you have to clearly classify this item into the particular account. Right? Then import and export here, manual, balance of payment manual. Yeah. Now in the examination, the knowledge about these things are important. Now I am going to discuss another important related to this one, foreign exchange market. Excuse me. Now its time is 11:49. Yes, I can finish that. Now these informations, inflow of dollars, outflow of dollars, related to the foreign exchange market. Now I am going to the table, blackboard. Can you see the board now? Now go to the board. Go to the board. Can you see the board, please? If you don't, Please tell me. Right. Foreign exchange market. Foreign exchange market. Can you see the board? Hello? Yeah. Right. It's a market. Foreign exchange market. It's a market. We have two sides of the market. Demand and the supply. Demand curve and the supply curve. Now we have to ask this question in this foreign exchange market. Demand for foreign exchange. Supply of foreign exchange. Demand for foreign exchange, supply of foreign exchange. Now I have not marked these two axes. Now I want you to answer my question. Two things. Who demand foreign exchange? Who demand dollars? Who demand dollars? Number one. Who demand dollars in the foreign exchange market? Who demand dollars? Who want dollars? Tell me, who demand dollars? Who demand dollars? Yes?
Exporters.
Sorry? Exporters or importers? Who demand dollars? And for what? Sorry? Exporters?
Yes.
Exporters? Why exporters? If you want to buy a car from US, from Japan, you have rupees, right? You demand dollars. You go to the bank, open an LC, you convert your rupees into dollars. You demand dollars from the bank. Why? To buy these foreign goods produced in Japan. So imports of goods, imports of services demand dollars. Right? If you want to travel abroad, go to Mecca, go to Buddha Gaya, then you go to the airline, you pay the open air ticket. Also, you pay in rupees, but banking sector pays that in dollars. Right? So the demand for goods and services depend on imports. Importers demand dollars. Now in this axis, then you can understand this one. This is the demand for dollars, the quantity of dollars. Not the rupees, quantity of dollars. Some textbooks, they indicate quantity of rupees. Then whole thing change upside down. Then quantity of dollars, demand for dollars depends on imports. Imports of goods and services. If you want to buy a car, if you want to go abroad for medical, medical purposes, get treatments, or if you want to go to foreign university, King's College, UK, right, or some of the other Monash University branch in affiliated college in Malaysia, right? Then tuition fees. You demand dollars. Your parents go and demand dollars. They are rupees. They demand dollars. Imports of goods and services. Demand dollars. Supply of dollars into foreign exchange market. Supply of dollars into foreign exchange market. Supply. Exports. Goods and services. Interaction between imports and exports determine the price. In the market, there should be a price. Price of coconut. Quantity of coconut. Demand for coconut, supply of coconut determine the price of coconut. Price per coconut. Now my question is, what is the price determined by this demand and supply, and it is called what? What is this price? What is this price? Demand for coconut, supply of coconut, determine the price of a coconut. Demand for coconut, supply of coconut, determine the price of a coconut in rupees. Rupees per coconut. Understand? Then demand for dollars, supply of dollars, determine the price of a dollar in rupees. Another name for this one? Tell me. Price of a dollar is called what? Anybody can answer? Price of a dollar called what? Price of a dollar is called what? Exchange rate. Exchange rate. Exchange rate rupees per dollar. Our commodity is dollars. If our commodity is coconut, rupees per coconut. Now commodity is dollars. Quantity of dollars. Rupees per dollar. 195. Rupees per dollar. Rupees 195 equals $1. Exchange rate. This is exchange rate. Understand? Now this is called the foreign exchange market. Foreign exchange market determines the foreign exchange of a country. Country's exchange rate. Exchange rate. How many the domestic currency is exchange rate is the price of a dollar in domestic currency. Price of a dollar. If you have 195, you can buy $1. Price of a dollar in domestic currency terms. That's another definition of exchange rate. What is that? Price of a rupee in dollars. Price of a rupee in foreign currency terms. Other way around. Now this diagram is drawn. Quantity of dollars. Exchange rate rupees per dollar. This is the exchange rate rupees per dollar. Right? Another journalistic classification of exchange rate is called dollars per rupee. That's why I said in that the diagrams is like this. In that case, it is quantity of rupees. This is dollars per rupee. Dollars per rupee. Demand for rupees. Supply of rupees. Now demand for rupees is exports. Supply of rupees, imports. You supply rupees. You go to the bank and you supply rupees. Demand depends on export. Other way around. If you classify axis, quantity of dollars and rupees per dollar, this is demand for dollars, supply of dollars. If you classify the axis, quantity of rupees and exchange rate, dollars per rupee, we are rupees per dollar. Then this is 1 over 195. Rupees, the dollars, 1 over 195 equals 1 rupee. Two definition. But this lesson we are going to use this definition. Quantity of dollars, exchange rate. Rupees per dollar. How many rupees domestic currency per unit of foreign currency? 195 rupees equals $1 foreign currency. That is our definition. But remember, this is not correct. This is not wrong. Some textbooks, like sometimes SIMA, Chartered also, you may have seen definition of exchange rate is that is dollars per rupee. Then demand for dollars. That's why one of you answered the exporters and import. In that case, classification different. In economics textbooks, we use this definition. Both are correct. Both are correct. Perfectly correct. No problem. The analysis is correct. Now we come to this point. This is our exchange rate. Another announcement. Coming 17th after the Sinhala New Year, Hindu New Year, 17th and 18th, no classes. I might take class on 24th. 24th is next Saturday. '24th is yes. 17th and 18th, no classes. IBS course. 24th Saturday. 24th Saturday, same time we have class. Right? Yeah. Right. So we are going to discuss, but in my recording you can see this. Right. This is our diagram for the analysis, right? Now demand for dollars coming from import. Remember imports data, 19 million worth of goods plus some services also. All the demand. Exports, remember, 11 billion, 12 billion coming from BOP account. BOP account, that is so balance of payment is the source for this diagram. Determine the demand and the supply of dollars into the country. And it determines the exchange rate of the country. This is the source, exchange rate of the country. Right? Now I am going to ask questions. So these type of questions you can expect in the coming 12 we have, right? Paper, right? Suppose the government impose restriction on imports. No vehicle imports, no unnecessary imports. Unnecessary imports, right? What will happen? How to analyze? This is a shock. This is the policy. How to analyze impact of this policy on the exchange rate? Will that policy, imports, banning of imports, banning of non-essential imports, vehicle import, affect to the demand side of the foreign exchange market or the supply side of the foreign exchange market? Definitely demand. Demand will go down. Demand curve shifts down. Why is that? Without any restriction, with any restriction, D to D1, D1. Now what will happen? Exchange rate decreases to 190 rupees per dollar. This is a policy. What is this policy? This one. Now, that is post-COVID. This is because of the COVID, government was compelled to put this restriction. They don't like, but they can't do that. But the consumer, as a consumer, now I can buy a flip for this the telephone, right? So I have to be careful when I use this. Like that, huge number of consumers have been affected. Electrical items, expensive. Computer accessories, expensive. Idea is to control the draining of foreign exchange. Now there's another shock. Another shock. What is that? Right? Supply side shock. Export dropped. Supply of dollars dropped. Foreign remittances dropped. Supply of dollars dropped. Then I'll come to that point. These are the keys of travel. No tourism. Airport is closed. The tourist earnings drop. Worker remittances drop. Export drop. Then travel drop. These changes, these shocks, COVID shock, COVID related shocks affect supply of dollars. Supply curve shifts this side. This is, now this diagram I can tell you the imposition of restriction on imports. Imports drop. Now I'll draw the supply side shock. Supply side shock again. This is in your recording, right? Supply side shock. Same diagram I can use. Quantity of dollars, rupees per dollar. Exchange rate, nominal exchange rate. Then you have demand, supply, imports, exports, exports of goods and services both. Now exchange rate, 195 I said, 195 rupees equals $1. That exchange rate. Right, okay, demand. Now what will happen? Supply side shock. Supply side shock. What are the shocks? Recently, our economy got because of the COVID. Drop in worker remittances. Supply drop, I said. Drop in exports. Our markets disturbed. Drop in the supply. Then tourism drop. Supply of dollars drop. That affects the supply side of the foreign exchange market. Supply of dollars, supply of foreign exchange, supply curve shift to the left. What will happen? Exchange rate depreciate to 200. Exchange rate increases E to E1. Supply side shock. Export earnings, tourism, worker remittances. Supply side shocks. Drop. Exchange rate increases. Rupee depreciates. Depreciation of rupee. Dollar depreciate. Right? Yes. Depreciation of rupee. Right? Earlier, if you have 195 rupees, you can buy $1. Now you need $200 to buy $1. Including exchange rate increase. Increase in exchange rate is the depreciation of rupee. Depreciation of currency. Depreciation. Value of a rupee going down. Earlier, 195 equals $1. Now 200 equals $1. Depreciation of rupee. Value of a rupee has gone down. That is another shock. Supply side shocks. Right? We discuss import restrictions, supply side shocks. Another one. Now, because of this uncertainty in the world, the foreign exchange market, almost all the investors, financial investors, they went to the risk-averse situation. In their countries also, you have this uncertainty. People are dying. Activities are coming down, growth rate is negative. Unemployment is increasing. Exports are coming down. Other countries, all our trade partners all over the world, it's a huge shock. In that situation, investors in our portfolio investors, in our portfolio sector, portfolio investment, treasury bills and treasury bonds market, foreigners withdraw their funds. Foreigners, okay, foreigners bring their dollars and they invested this in our foreign government treasury bills and treasury bonds. Now they say, we need any money. We are going to bring back our dollars. Please give our dollars. Please give our dollars. Then what will happen? Demand for dollars increases. Demand for dollars increases. There's a huge outflow of dollars. Foreign investors, now they demand dollars. Because of this, not only in Sri Lanka, this is a situation in almost all the countries, developing countries, in other countries, they are facing. Because the people discover situation. This is our situation. We don't want to keep our money abroad. We get this money. Bring back money. Then what will happen? Demand for dollars increases. Third shock. Demand for dollars increases. Then what will happen? I will use the same diagram. $195. Now what will happen? Now this supply side shock. Now withdrawal of foreign investors, withdrawing of dollars, pulling out of dollars. Invest in treasury bills and treasury bonds. Another demand side shock. What will happen? Demand for dollars. These foreigners want to withdraw. Demand for dollars. Demand for dollars. They withdraw funds. Then what will happen? Demand for dollars increases. Demand for ships. Exchange rate depreciate to 100. Understand? So these are the shocks coming to this foreign exchange market because of the COVID, right? The restriction imposed by government, banning non-essential imports. Number 2, drop in export earnings, drop in work remittances, drop in the travel tourist earnings, supply side shock. Okay. Country had to face, government had to face, people had to face, companies had to face these shocks. Right? Then withdrawing funds invested by foreigners in our treasury bills and treasury bonds market, sometimes share market also. They sell the shares and outflow foreign the sales increase. Again, that will be demand side shock. For the COVID, this period now we had to spend only 2 years, 1 year, almost. So it's a shocks in the huge shocks in the foreign exchange market. Foreign shocks from supply side shocks, demand side shock. Then what will happen? Exchange rate tend to increase or decrease. Now this is happening. Now our exchange rate is around 100 yesterday it was 190, between 196 and 109, buying and selling rate 196 and 199, I can remember. Once it went up, exceed the $200, right? Now huge shock coming. When exchange rate depreciates, what will happen? Imported things will be expensive. Imported items will be expensive. Imported rice, imported fertilizer, imported other consumer goods will be expensive. Then what will happen? Domestically, it will create price pressure on the domestic price level. Pressure. Imported inflation. That will be inflation. Price level tend to go up. That directly affects the living standard of the general public. The inflation is the #1 public enemy. Inflation is said to be the #1 public enemy. Inflation is said to be, is called the #1 public enemy by economists. By that, when price level increases, 10%, inflation 10%, 15%, 20%, things will be expensive on average. Then you can't afford. Your wages, your earnings, returns will not increase same rate. If they do, then you don't have any issue. But private sector people, workers, government sector employees, their salaries, they don't revise. Even union can't ask for higher salary increases. They do, right? But they can't, these companies cannot grant, government cannot grant these salaries. If salaries increases at the same rate as the price increases, your living standard is okay. But that does happen. Understand? So this will be one of the questions in the paper. Impact of COVID on the exchange rate. Analyze the exchange rate on the impact of balance of payment. Through the balance of payment, that will affect the exchange rate. Through the exchange rate shocks, that will affect the general price level, inflation rate. When these export earnings decreases, worker remittances decreases, then other shocks coming, travel earnings, travelers, travel sector, travel agent sector is affected, unemployment in the economy. So COVID has unemployment also, generated unemployment in the economy. COVID has decreased growth rate to negative 3.6%. Sri Lankan growth rate. Dropping growth rate means falling in unemployment, increase in unemployment rate. People are more unemployed. Right? Then the demand for goods and services decreases when the growth rate falls, when people's income decreases, aggregate demand decreases. That is another problem. So now today we discuss a link between balance of payment, and this is the balance of payment and the exchange rate, foreign exchange market briefly. Right? So these diagrams are very important. Please understand this diagram. So I have analyzed 3 types of shocks: 2 demand side shocks, 2 the 1 supply side shock. So you should be able to analyze those shocks. Then the balance of payment. Balance of payment sector. What are the key accounts? Then under each account, who are the giants? You have to know. Intermediate imports, fuel, giant. Textile inputs, giant. Intermediate imports. Then the exports sector, who are the giants? Within each sector, who are the giants? You have to know that. Well, then, why the BOP account is important in determination of exchange rate? That is important. Please go through the last March paper. Now, this is high time you to go through these papers with the examiner's guide. There's a question number 4. Is on this the COVID shock. This year also definitely you will get shock. You will get question from the impact of COVID on the various macroeconomic accounts. Right now, I'll give the brief introduction to the next week lesson. That is on 24th. ISLM model. ISLM model. ISLM model. So at the beginning, I mentioned the various accounts, right? National income model, aggregate demand, aggregate supply model, ISLM model. This is ISLM model. The ISLM model, like in microeconomics, demand supply curves. IS curve and LM curve. IS curve and LM curve. IS curve line. IS curve represent the macro sense goods market equilibrium. Not only one particular good, aggregate demand. Aggregate goods market equilibrium. Demand, aggregate demand equals aggregate supply. Goods market equilibrium, IS curve, downward sloping. LM curve represents the money market equilibrium. Demand for money equals supply of money. Demand for money equals supply of money. Money market equilibrium. Right? So the interaction between demand and supply, this IS and LM curve determines IS and LM curve determine the equilibrium interest rate and the output national income. So So IS curve represent the goods market equilibrium, LM curve represent the money market equilibrium. Like in this foreign exchange market, you should be able to analyze various shocks. IS curve on the LM curve, right? IS curve determine the government expenditure, government budget, budgetary policies. LM curve represent the central bank monetary policies. Shocks, changes in the monetary policy, shift LM curve up or down. Shocks, changes in the fiscal policy, shift the IS curve up or down. Accordingly, equilibrium interest rate and income changes. This will be the subject matter in coming 24th. If I need more time, I will take following week also. But 24th, definitely I will try to finish this ISLM model. Up to now, it's okay. We'll finish this lesson. Please start reading the March paper. Get the March paper and the examiner's guide, and almost we have finished around 95% of the syllabus. Once if I finish the ISLM model, and I must say 99%. Right. Okay. Please get the past papers and go through them. We'll stop now. Thank you very much. Thank you for listening. We'll see you. We'll see you on 24th. 24th. Right. Okay. Thank you.
Thank you, sir.
Thank you.